Good morning, welcome. As a bid to stay on time, we will begin only 3 minutes late today. My name is Rachel Leeds. Our commission from the law school this morning is to talk about 2 generally unrelated topics. First would be mobile payments and the disruptive force they are causing to traditional payment systems. And second, the innovation of crowdfunding in corporate finance. Before we begin, a couple of quick reminders. The university wants me to remind you to fill out your evaluations. Everybody has a pink sheet in front of them. Please fill those out and return them to the front desk. Somebody will read those. Second thing is we only have an hour, but we want to make the most of our hour. We want to make it as practically useful to you as possible. So we encourage that if you have questions or if you have comments, please pose them at any time during the presentation. We'll incorporate them in, do our best to answer them. So please ask questions. Let me begin by introducing our panel. To my immediate left is Oliver Bremen. He is the Chief Financial Officer and General Counsel of Cleverbridge. Cleverbridge is an international e-commerce platform. Oliver told me they have offices in Japan and 2 domestically, 1 here and 1 in Chicago. Next to Oliver is Erin Fonte. Erin is a partner in the Austin, Texas office of Cox Smith. She has an extensive national practice focusing on, well, precisely this, payments. Whether mobile payments, traditional payments, financial institutions, regulation, and compliance obligations. Erin, we're also indebted to for giving us most of the wonderful material that we have attached to the mobile payments section of today's presentation. I encourage you particularly to read her law review article from University of Washington Law School, I think, Erin, which does a wonderful job of laying out the framework of regulation of mobile payments and mobile payments. Next to Erin is Jeff Capel. Jeff is a partner in the Washington, D.C. office of Elias, Mass, Tiernan, and Herrick. He is a corporate finance practice emphasizing securities and has developed a little bit of a subspecialty, I believe, Jeff, in crowdfunding. Jeff also has a wonderful blog. Jeff also has a wonderful blog focused on crowdfunding. I encourage all of you to bookmark it. Great source of not only news, but timely commentary. Finally, but certainly not least, is John Muller. John is Vice President of Legal and General Counsel of Takeoff. John tells me that one of his particular interests in mobile payments is that he spent part of his formative years growing up in Latin America where there were very strict trade barriers but very limited loose currency controls, so there's a native interest in the way currency is moved. We'd like to begin with mobile payments and with John Muller. John, there is a Juniper study out there that says, maybe ambitiously, by 2017, the total value of transactions consummated using mobile payments will reach $1 trillion. I think because it's such a rich market, we lose sight of what are mobile payments. From the privileged perspective of PayPal, can you talk to us about what do you see out there? What really are mobile payments? What's the distinction between mobile payments and, say, mobile banking? And where are we going to the extent that we can see in 3 days and months?
Sure. So thanks for that lead off. And that's one of the things I will try to do is to kind of give a little bit of a business-oriented landscape of what people are talking about when they use the term mobile payments, because it is now used quite broadly to cover a lot of different types of payments, some of which only have a perhaps tangential relation to the mobile phone. So let me start by trying to categorize those what the media is referring to when it uses that term mobile payments, partly because of studies like the one you mentioned, and perhaps partly because the technology usage is starting to reach a tipping point. Certainly it is an area of much greater media interest than it was, say, 2 years ago, when many of the technologies were already available, but there was just much less publicity around it. But the way I look at it, there are really, in essence, 6 different types of payments that tend to get lumped in or types of activities that tend to get lumped in under mobile payments. Because arguably some of them aren't even directly payment related. And probably perhaps the first one, and the one that perhaps gets the most attention these days, is using mobile payments at a physical point of sale. Sometimes also referred to as proximity payment. So that's using typically your mobile phone, your smartphone, to make a payment at a physical retailer. And Starbucks is probably the most successful example, and the one that probably most people are familiar with, of holding up your phone, in essence loading the app onto your phone, loading some value onto it, and using the barcode or QR code with the reader that they have installed at Starbucks or around the U.S. To pay for your coffee beverage. And that has been very successful for Starbucks, and now, and even before Starbucks, there were a lot of attempts by the payments industry to start building out that infrastructure. So you see a lot of the technology acronyms thrown around. You might hear about near field communication, or NFC, which is in essence an attempt to build card infrastructure into a chip on the phone, or into a secure element on the chip on the phone. There's also use of other technologies like QR codes, potentially like radio frequency or RFID, even though big obstacle there is less security. So there are all these various technologies. And then there's also just using the mobile device, even though you're standing at a physical retail point of sale, to communicate to the company's servers somewhere else and send a message back to the retail terminal. So often referred to as using the cloud instead of using NFC. And so that's very active area. And really, in fact, just yesterday, there was an announcement that the group that was incubated or accelerated here from Stanford has raised $25 million to start a new company called Crinkle, or expand a new company called Crinkle, which is trying to do the same kind of digital wallet or mobile wallet. And they use, the rumor is, and it's always dangerous to rely on rumor, but the rumor is they use high frequency emission from the phone to communicate with the device at the merchant. So maybe your best practice in payments, since this panel is titled Best Practice, is just to go out on the Stanford campus and see if you can find some undergraduates who are still around and start a new company. So that kind of proximity payment is really just one type of mobile payment. And for PayPal specifically, and for I think several others, Google as well, it's not yet the largest type of payment. For us, the largest type of mobile payment is using a mobile device, typically to do online commerce. So either accessing a website using the browser in your mobile device, either of course a phone or a tablet. Tablet commerce is very much part of this story. Or accessing through a mobile application, either the payment company's application or the merchant's application. And I'm sure one of the interesting regulatory issues that the rest of the panel will get into is when a merchant embeds the payment portion into their application, especially if the merchant is running some kind of platform business, at what point do they become a payments company that gets regulated? The third kind of payment that is often referred to as mobile payment is what's called carrier billing, which is usually used for very small payments, like you might pay to buy an item in in a game. So it's some kind of digital good typically where you're only paying $1 or $2 at a time. And to get started very quickly, to not have to type in 16 digits plus an expiration date on your mobile phone, you can agree with certain services to just have that $1 at a time or $2 at a time placed onto your mobile phone bill if the payments company has set up an arrangement with the carrier. So carrier billing companies that are active tend to have somewhat lively names like Boku and Bango and Zong, which is a company that PayPal acquired in 2011. But that's certainly what people sometimes refer to when they talk about mobile payments, even though you don't necessarily have to have your mobile phone. The payment itself is happening on your mobile phone bill. And then yet another category is mobile merchant acceptance of payments. And here the poster child, the big name is Square. It's plugging a device into your phone that acts as a card reader, and in its more advanced versions, you don't necessarily have to actually read a card. It can locate the consumer's phone without actually swiping a card. But for most people who may not have that app downloaded when they walk into the merchant location, all they're doing is swiping a card, and this card reader is replacing typically much more expensive hardware that the merchant might otherwise have to buy. Clearly that is expanding the universe of card acceptance to very small locations and to businesses that are themselves mobile, like food trucks and so on. So that's a very big opportunity. Then the fifth category, I'd say, is sometimes called mobile banking, or often what they really mean is mobile, is attempts to do cash replacement. This is typically, so far at least, international, and the most prominent success story is in Kenya. A company called M-Pesa, which is partly owned by the local mobile carrier, has developed basically a currency, that stored value that you load onto your phone and can then be used fairly widely throughout Kenya, including for person-to-person payments, so not just for commercial payments. They've now gotten so successful to the point that the government has now imposed a 10% tax on their transactions, which unfortunately has slowed the growth rate the last 2 months, but certainly the attractiveness is there. And also in many countries, just carrier minutes themselves can be transferred and can act as a form of transferring value between people. And it's really an attempt to find ways, in countries where there's an even larger unbanked or underbanked population than there is in the U.S., and certainly not to be overlooked in the U.S., where, depending on which estimate you believe, it can be 15 or 20% of the population falls in the so-called underbanked category. But in other countries, it's much higher. And so there are these various efforts to take advantage of mobile phones to get the population into the formal payments network. And then finally, I mentioned a category that again is perhaps not directly linked to payments, not necessarily linked to payments, but tends to be connected, and that is companies that are building out relationship with merchants to make it very easy to develop loyalty programs and to take what used to be a paper coupon and put it onto your mobile phone. So companies like Shopkick and RetailMeNot and Coupons.com, which themselves aren't necessarily They don't have to do the payment itself, they can just process the coupon or loyalty program. But it's fairly natural that they would want to combine the payment aspect with the offer of, get your $5 off or get your 20 loyalty points for the next time you come back. So all of those, to some degree, get lumped in with mobile payments, and that helps account for these large numbers that get thrown around. They all create their own legal issues, which I'll turn over to the rest of the panel to do the hard work of explaining the legal issues.
Well, I want to come back in a moment and talk about the really giant success story of mobile payments internationally, but it probably makes sense to start domestically. Aaron, you've noted before how mobile payment companies really are in a daunting place. They're at the intersection of banking regulations, privacy regulations, money laundering, anti-terror regulations, possibly telecom regulations, FCC, FTC.
That's not possibly.
Can you give us a framework?
So, sure, and first of all, thank you guys for coming. It's actually wonderful to be back. I was walking around the law school. I graduated here in 2002, and it's fancy now. And until I found the old corrugated cardboard looking older classroom building, I did not know where I was, and I was like, ah, yes. So it's wonderful to be back. And I would just say, keying off a lot of what John said, and that was a fantastic summary of kind of what's going on out there. 5 years ago, I've been in the payment space for about 10 years. 5 years ago, payments were not sexy. Trust me about this. It was a very staid environment. The repeat players, everything was fine. And if you come to Austin, where I am now, Austin's, we're cool, whatever, with South by Southwest, we have turned into an intersection of Silicon Valley, Silver Lake, and Brooklyn. It is, it is like if you see three guys with beards and plaid shirts, they are starting an app, and sometimes it's a payments app. And so we've had a lot of innovation in and around financial vendors, and also the app space and the payment space. There's a mobile wallet startup called Tabbed Out, and a very Austin thing. They started because a guy was upset that he couldn't pay his bar tab. It took him an hour to pay his bar tab, so he's like, I should be able to do that on my phone because I need to pay my tab and go down the street and drink somewhere else. And that is literally now a company. And they're doing quite well. So I would say what is interesting to me is this harkens back, does anyone remember the whole discussion about telecom convergence? Okay, internet, cable, telecom convergence. We are having payments convergence. And you guys as consumers and maybe as businesses you're seeing this, your day-to-day has not changed that much yet. I think probably the biggest innovation is how many people here have deposited a check using their phone. There we go. And are you happy with that because you don't have to go to the bank? You might have been a little scared at first, but then it worked out and you're like, this is awesome. So I think, when you're talking about what's going on, I'm going to lead with some resources because we don't have a lot of time here, but the Mobile Payments Industry Work Group from the Boston Fed and the Atlanta Fed has been tracking the mobile payment space for 3 years. In May, they released an update to their version of what's going on in the space. It's an incredibly interesting read from an industry perspective. They get together stakeholders from telecoms and banks and retailers to talk about all these issues and where they think this whole convergence is headed. If you look at my materials that I have, I was part of a mobile money conference at the University of Washington, and there was someone from Central Bank of Kenya, from M-Pesa. I did the law review article because there was not one out there that talked about a comprehensive way to look at the mobile payment space and what the regulations are. So it's a pretty good resource, I think, and also U.S. Department of Treasury is going to use my resource as part of their packet of materials for a gap analysis they're conducting with the other federal banking regulatory agencies right now. So it has that in Dish or whatever. Bankers. I would say if you want to know what's going on within the banking world, and there's a lot of grumbling and nervousness, there's this, it came out on June 19th, is Changing Face of Payments. This is the bankers' critique of what's going on with these alternative players coming into the payment space. And they are focusing on what's the consumer protection? Are these guys going to comply with regulations? Also, let's talk about competitive equity. Why do we have to spend money on compliance and these guys get to skate for free and they're not regulated even though they're doing the same thing? Regulators last summer came out and said, look, we don't look at whether you're a bank or a non-bank. We look at the activity you perform. And believe me, I have had more than one conversation with these really eager guys and gals who want to do a payment startup. And when they tell me, hey, okay, yeah, we move the money and it comes this way and then it goes through our bank account, at which point I was like, whoa, 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 whoa. the money's going through your bank account for the company? And they say yes. And I was like, guess what? You're a money transmitter. You need money transmitting licenses at the state level. And they look at me like I've grown a second head and just crushed their hopes and dreams. But I say you don't look good in orange, so let's talk about criminal penalties and then we'll talk about why you need it. If you are looking at the regulatory framework, you've got traditional banking functional regulators, Federal Reserve, OCC, FDIC, the Credit Union Administration. FTC was involved on the privacy side, but also Graham Leach Bliley, so they've been in the traditional space. Financial Crimes Enforcement Network. Anyone seen the Bitcoin stuff going on with that? Okay, we can talk about Bitcoin a bit. But they look at money laundering, terrorist financing. All those folks are in that space. When you start looking at the new Consumer Financial Protection Bureau, they have a mandate to regulate non-banks that provide financial services. Those guys are pretty aggressive at what they do. And they are starting to look very hard at the prepaid space, which if you're talking about major disintermediation, PayPal in the online space, obviously, you're trusting this third party who's not a bank to make your payment. Prepaid cards, I worked for the law firm that helped launch the Blackhawk network for Safeway, and that's the first people who put gift cards in the stores. That was a big thing. I'm trusting this third party who's not a bank with my money. The disintermediation that's happening, has been happening slowly with this thing that I walk around with as a small computer. I only carry my phone, my driver's license, and payment cards now. All my loyalty card just started on my phone through an app called Keyring. This is the future. If I can get away from even having the driver's license and payment card, that'd be great. But the problem is you've got these traditional regulators. You've got a new agency that wants to make a name for itself and is very concerned about consumers. Then you've got people like the FCC who are all of a sudden like, wait, we're involved in this? And you are, because the FCC has to enforce the Truth in Billing Act. And if you do charges to the phone bill, there's a danger of cramming and of fraud. And I would say if you're looking at the key regulations in the space that pretty much apply to a lot of consumer transactions, Regulation E, which is Electronic Funds Transfer Act, that's if I alert my bank about fraud, I'm only liable for $50 if I do it in 2 days, and up to I think $500 within a week or so. And then there's the issue of truth in lending. Now what's happening is you're starting to see, I don't want to go into bill later, but are you doing something that's going to be extending credit? If so, truth in lending comes into play. Now that's just at the federal level. There have been some very aggressive state regulators, California would be one of them, Illinois is another, who are starting to look at these things saying, you know what, you're actually violating our money transmission statute because you don't have a license and we think you're transmitting money. The action against Bitcoin is a little speculative. I don't know if Bitcoin exchange is actually moving value around, but the California Department of Financial Institutions says they are. Illinois just took action against Square, NetSpend, which is based in Austin, some other prepaid card issuers. So I think you've got this issue of prudential regulation from the regulators saying, you want to let the market evolve, but once you start getting consumer complaints and problems, that's when they kind of take their cue to step in and kind of examine what you're doing and to say, if your activity is such that falls within the regulation, what are you doing to comply? CFPB has this new thing called UDAP, is what we're calling it, unfair, deceptive, and abusive acts or practices. We asked them, we regularly meet with regulators in DC, we said, what's abusive? And they said, oh, we know it when we see it. I was like, great, it's a pornography standard, that's wonderful. There's no bright line rule, and they've started something called Project Catalyst where they're trying to take a look at and get under the hood on some of these new financial services and products, and I'm not quite sure where they're headed with that other than to say, you need to redesign this. And the big question is, can someone like the CFPB come in and say, actually, we think your entire product is deceptive and serves no purpose? Kind of what they're trying to do with overdraft protection, in my humble opinion, representing banks. The ABA paper, I think, really serves up the tension that's going on in the space right now pretty well. Because these guys are entrenched players, and I represent a lot of banks, but I also represent mobile wallet developers, and I also represent retailers on a lot of stuff, so I kind of see everybody's argument. The reason people are interested in this space, there's a huge class action settlement that's been going on, the case has been going on for 8 years, the settlement has been approved, there's a fairness hearing in September. This is on credit card interchange. So Durbin handled debit card interchange, credit card interchange. If I throw the number $7.02 billion at you, that is a large number. It is going to be the largest antitrust class action in history in terms of settlement. It is equal to approximately 3 to 4 months worth of interchange in the system. So wrap your head around that. because the card companies make a lot of their profit off of interchange. No one has really gotten to see behind the economics to figure out just how much money are they making. Silicon Valley says we want to make things more efficient. Other people say we want to get behind the curtain to make things more efficient. So there's a lot of economic vested interest between issuing banks and the card networks and others who are saying, whoa, 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 we don't want to rock the boat too much. And so, you know, they talk about things like consumer protection. Does the payment method provide consumer protection consistent with what current regulations are? Are the rights clearly disclosed to the consumer and easily understood? Payment system integrity. Hey, our payment system works pretty well. If you introduce new unregulated players, is that going to introduce weaknesses, more fraud, more problems, and then all of a sudden you get a spike in people complaining about their payment function? And then that issue of competitive equity, I like to call it regulatory arbitrage. This person, A, is not regulated, so they're blowing and going. This person, B, is hamstrung because they have to spend a lot of money on compliance. I would say with the regulatory gap analysis that's going to happen, you will start seeing more and more enforcement action in the space. From a business perspective, there's something like 168 mobile wallets that are, quote, out there right now, and they kind of range in functionality. You're going to see consolidation from that perspective. And I think once the regulators start taking an enforcement action against somebody, then you're going to see kind of the ripple effect through the industry.
Let's move on quickly to international regulation. John mentioned that there's a very large in Asia and Africa unbanked or underbanked population. Enormous success stories there. Oliver Bridge has a large international presence. How is the regulatory structure there different, responding obviously to markets that don't have these archipelagos of physical branches, well-established regulatory systems, well-established payment systems?
Yeah, so what I want to do is, so Crowdfunding is an e-commerce provider. What we do is we integrate payment methods. We are not a payment service provider. So we see it really from the merchant perspective, what's out there, and also some of the discussion that I've seen over the last year, some of the hype, I think, around this topic. So what I would like to do now, I will go into more like best practice of what we see from the merchant side in a later point, but from the regulatory side, I think it is important to understand, take a look at some of the markets that were actually very successful in the acceptance of mobile payments. And both Nate and John mentioned two markets which I think are interesting to look at. One is the African market, not so much probably from the economic perspective, what most people do here in the audience, but it's really interesting to understand that there are statistics out there that there were in 2012 more people using mobile payments in Africa than there were bank account holders. So it is really important to understand that this is a payment method which is becoming is number one payment method, and part of the reason is really that there are not many alternatives, which I think says a lot, at least from my perspective, about the slow acceptance that we're still seeing for the core mobile payments here in this country or in Europe, for example, because there are just a lot of alternatives out there that people use or get used to. In some way, some of the new technology might be interesting, but I think the adoption rate is more on the slower side because there is not the immediate need for a lot of people to move into new technology. In some way, with your credit card, you have a mobile payment in your wallet. You can basically use it, you can carry it around, use it anywhere else. And there's a lot of new technology that would require new investment from the merchant side or from the user side. The other example which I think is interesting is the Japanese market. The Japanese market had a very strong mobile payment environment based on a very proprietary technology used in Japan for mobile phones. For people who have traveled to Japan, it was like 10 years ago, it started very strongly that the Japanese system had actually mobile phones that were very specific to the Japanese market, supporting not only different characters and everything, but basically had integrated some of the technology that we're seeing, it still has a low adoption rate, like NFC and so on, and those widely used, very often connected to banking or the carriers. What they see now is actually a very interesting aspect by moving to some of the new smartphone technology. These technologies are not supported anymore. So there is, when I talk to our people in Japan, they say there's actually sort of a drop in some of the adoption that you have seen in the past because people are not having these phones anymore that they get from their carriers that are well integrated in existing systems. And now with systems like Android phones or iPhones, there's a lot of technology which is simply not supported at this moment in time. But both of these environments going on the regulatory side, every time I speak to people from mobile payment industries, they say, regulation in Africa, of course, is relatively weak. It is actually difficult to even see who you have to talk to actually know what you have to do. The African countries, I think a lot of them are getting more into the habit of seeing that this is an important part, and by currently taxing it, as you learned from Aaron, they really see where the money is. So they understand that to kind of foster that, it is important for them to get more involved, and hopefully it will lead to more regulation that makes it easier for providers actually to get into the market. The Asian market still being strong, but that traditionally has happened more out of a practical employment, not so much from a regulatory perspective. What I can really talk about, I think, is the European perspective, which is important as a large market that is still also lagging behind, but it's certainly one of the markets that a lot of people here in the room are probably interested in. It is important to understand at this point in time there is no real mobile payment regulation in Europe. There are a bunch of different directives and regulations and authorities dealing with this, as we will always have the case in Europe. There's a lot of discussion going on. But so far there is nothing really on point. There are a bunch of directives which might become interesting, and maybe to start with, one of the most prominent one, the e-commerce directive, doesn't speak about payment at all. So you will not find anything there when you have going look into that directive, which is important for a lot of e-commerce going on. There are directives about e-money, the e-money directive on 2000 actually, that might be applicable if your mobile payment method uses e-money, the issuance of electronic currency. The more important one is the Payment Services Directive that was issued in 2007 and then again revised in 2009. And that has basically two parts. The one part is the regulatory part about payment service providers, and John and both Aaron mentioned that it gets easily over the threshold of if you are a merchant or if you're a payment service provider, if you are transferring funds, for example, through your own accounts, you likely fall in the second category. And so that is basically the equivalent of the money transmission law that you see in a lot of US states. The second part, and that is also important, that I think everyone who dealt with European regulations before know, there's a very strong consumer protection part in everything that the Europeans do. So some of the terms that we refer to, for example, the multilateral interchange fees, is a big concern in Europe, as traditionally privacy and security is also. So a lot of that deals with how much information has to be provided to consumers, what type of fees are acceptable and unacceptable. So that is the Payment Service Directive. The Payment Service Directive is also very important for something that people have to know if they look into the European market, which was SEPA, the Single European Payment Area. The idea of SEPA was an initiative that started in 2008 by European banks, and the idea was to actually create a much more efficient way of transferring, especially funds in euros, between the member states. And SEPA has now changed into something that went from the bank initiative. It has been supported in the second, basically the second European Payment Services Directive in 2009, kind of is sort of the legislative basis for SEPA, which at this point in time only deals with direct debit and wire transfer transaction in Europe. And that is actually, interestingly, not only the European Union, but it's actually European Union and ours have to get them together. It's Iceland, Liechtenstein, Switzerland, Norway, and Monaco. So these are basically, these countries form the SEPA initiatives, and the idea is really to make the money transfer between these states easier for the consumers. The SEPA is basically governed by the European Payments Council, which is this body created by the banks initially, and they now have picked up mobile payments as a very important new area that they want to go into. So we are now in the stage of creating white and green papers and having different conferences. The biggest concern that I want to address is, and I mentioned before, the interchange fees are important, security, privacy is a concern, interoperability. And in general, I think the underlying concern in Europe is really the fragmentation of the market. And what people really see, and what we have heard also from Aaron, is there's a lot of new technology going on. In general, in Europe, the concern is that Europe might fall behind. Most of this technology that is developed is probably more in the US or maybe in the Asian market. The European approach, again, is to kind of do the regulatory approach and trying to support it. And the question, I think, will be in the future, do they really support it, or do they make it more difficult for the players on the market to get involved and actually start doing it?
Right. We want to spend no more than another 5 minutes with this topic before going on to crowdfunding. Before we talk about best practices, are there any questions? I hear a lot of keystrokes and I see a lot of questions being written down. Does anybody have a question they'd like to pose to the panel?
I've got a question. With respect to, generally we just spoke about regulations in Europe, when you speak to mobile payments, and I suppose just a general question, what exactly is that? Is that just any payment that's made on a quote-unquote mobile device? Repeat the question.
Yeah, so I think the question was really, about the definition of mobile payments, what actually falls under that. And I think John, mentioned a lot of this. I personally think, if you have a very broad definition, you can have everything fall under it. So that would basically mean, even if I go on a regular website with my iPhone, which, Aaron pointed out is just a small computer, and do a payment there, is that really a mobile payment? For me personally, I think it has to be more than just using a mobile platform. You could make the argument then, even a transaction from a laptop might be mobile. So it doesn't have to, has to be on a phone, on a tablet. I think there are different definitions out there, but from my perspective, it has to kind of employ some of the more specific specifications of a mobile device. I think the best examples are, of course, technologies that are used by only these devices like NFC or, what might be out there in the market. But I think it is an interesting discussion, also when you talk about the size of the market, what actually falls under that.
But the directives that you spoke about, do they get granular in terms of defining mobile?
Yeah, they normally take a very broad approach. So they normally say this is, basically everything that is done by a mobile device. So it could be, basically the payment, entering your credit card information in.
I'm saying, are they defining the mobile and mobile payments?
No, but they're basically, it's not so specific. Okay. Yeah, it is very broad.
And I would say you always have to realize the regulators are continuously playing catch up with technology. So, and I would say though, an interesting point on the U.S. side is look at when FinCEN, the Financial Crimes Enforcement Network, redefined prepaid access. That is one of the broadest definitions I've seen in U.S. law. And it's basically any code, anything that you can use to transfer value from one person or entity to another person or entity. So if you were looking at that definition of value transfer in a mobile device, FinCEN would say, well, yeah, that's what you're doing. And I would say that I think part of the gap analysis Treasury is doing is to see if there needs to be additional regulation or clarification on mobile banking and mobile payments.
And even the Electronic Fund Transfer Act, Reg E, which was written like 30 years ago, is defined very broadly. Basically, any access device to access an account is covered as an electronic payment. It doesn't matter what kind of access device you use. So already, mobile payments in essence are already included within the regulatory infrastructure, without having to specifically define or limit what is mobile.
Gentlemen in the back first.
Sure. Yeah, just on money transmitting license, what about e-commerce sites that provide escrow services for high value items, let's say, and the website's functioning essentially as escrow agent where a party is transferring funds via their credit card, let's say, to the service that then transfers the goods from somebody else? Would that be considered, would that fall under traditional legal principles of trust, or would that be considered something that falls within the scope of this money transfer license issue on mobile devices because they're doing this on their cell phone, let's say?
And Aaron, do you want to rephrase your
Sure. question? So I think your question was, there are certain sites out there that work as online escrow sites.
Right.
So I'm going to buy something from you. This is starting to sound familiar to John. I'm going to buy something from you and use a trusted third party to hold the funds until I receive the goods, and then the funds are released.
Right.
Okay. Isn't that what you guys do? So the issue there, I think, is you have to look at the state definitions in all 50 states because, yes, they are different. And so the question is, I can tell you in Texas, if you are holding value that will change in terms of location or time to be transmitted to someone else, and you're promising someone you're going to deliver that value at X date and X time to Y person, yeah, I would think that the state of Texas might consider you a money transfer. And the question is, that is subject to regulator interpretation.
And it's also, this is in fact really the first regulatory issue that came up at the state level in the payments industry. Before companies like PayPal existed, was there were some escrow services, and just to draw the distinction, where the escrow service is a company that won't release the funds until the buyer says they're satisfied. And most states have specific escrow laws separate from money transmission. Sometimes if you get one license, you can do both, and sometimes you need 2 licenses. And California in particular took fairly aggressive action early on against a company, I think it was called escrow.com, which basically forced them to move their servers out of California for a while. It's been strange, they didn't stop operating, they just moved their servers. So I'm not sure what regulatory purpose that served, but I think the general principle is if you're providing an escrow service online, you're probably going to have to address state escrow issues first, and then money transmission kind of supplementary to that.
Sir? So if I send an invoice from my email, the real question is with Vincent's guidance.
Oh, we're going to talk Bitcoin now, all right?
Yeah. Well, virtual currency in general,
Right,
centralized, decentralized, using definitions that appear to be broader than we would have expected before. Does it seem to also call in question now, some virtual value in game points, game objects, have always been on the crowd, it's happened for a long time. As far as I know, I haven't been called into question under this body of regulation, maybe it hasn't, but it seems like it's perfect.
A virtual currency is interesting. I'm going to talk aside from the Bitcoin issue. There's a case involving Second Life and Linden Dollars about someone suing for damages because Second Life terminated their membership in the organization.
Yes.
And did they have real dollar damages? That's a question that's been around for a while. FinCEN, were they clearly targeting Bitcoin? They were addressing Bitcoin, but it's broader than that. And so the issues really get tricky of, if I have virtual points that I'm exchanging for virtual goods and services, that's one thing. It's the moment you cash in, cash out, that the money transmission issues, MSB registration, all that stuff starts to attach. Real dollars in, real dollars out. Real yen in, real yen out.
And use it being treated differently when they move it over a paragraph down into Bitcoin, because it's Bitcoin up, Bitcoin out, it still seems to fall under what they consider a money transfer.
Well, what they were really targeting with the Bitcoin guidance, and if you know anything about regulations, guidance is no longer guidance, it's pretty much do it. They were targeting places like Mt. Gox that actually cash the Bitcoins out.
Yeah.
And the issue behind that, and what I will say is, there is a concept, the regulators, especially in the United States, do not like anonymity in money. They don't. And so when you create an anonymous kind of system where you can trade value, it's a race to the bottom. Drug dealers, money launderers, child pornography sites, Well, no, and the thing is, yes, there are legitimate uses, and this is unfortunately kind of a bad apple theory, yet there are so many more non-legitimate uses. What the government says is we want a window in to know who's moving what, so that we can do law enforcement.
And that was what I thought they were doing. In other words, they want to have one place where they can see the exchange. Yeah. Where if they need to, they can come in and they'll get reports of up to $10,000. They get suspicious information on suspicious transactions. The guidance seemed to go farther than that in terms of saying what might get regulated as, and how do you try to find that?
Yeah.
The question, I suppose, is would you expect more guidance? Would you expect that to be getting a lot more? The enforcement action seems to be against the bad guys. People that are clearly, it didn't seem to take a lot of, lawyers looking at it, it wasn't terribly surprising that Liberty Reserve was taken, or that Mt. Gox should have actually maybe done a little bit more regulatory compliance.
Which they are doing now. They got the message,
But would you expect, I think when we talk to attorneys and tax for SEC, we have a sense about how much more guidance we're going to get and when?
I personally think that FinCEN's been studying the issue, and the guidance is just really the precursor to formal rulemaking. And I would expect to see that at some point.
We're going to do a hard pivot at this point, Aaron, and everybody will be here after the session, but we need to make a hard pivot to crowdfunding and Jeff Capel. Jeff, first of all, how many people in the room, quick question, are either securities attorneys, corporate finance attorneys, or related areas? So Jeff, definition. Jeff, there are probably two ways of looking at crowdfunding. It's either the democratization of venture finance, great returns, or it's feeding the cupidity of unsophisticated investors. So can you define, probably two good ways of looking at it. Could you tell us what is crowdfunding, how did it develop, and where does it really fit in the cosmos of American corporate finance?
Wow. Okay, well, crowdfunding is really the process of raising a small amount of money from a large number of people. And the idea here is right, that it's meant to democratize the ability of the average investor, i.e. the unaccredited investor, to invest in deals that only venture capitalists and wealthy individuals have been able to see in the past. The ultimate goal really is to create a low-cost way for small businesses, for startups, and for other businesses that have been in business for a while to raise up to typically $1 million under these regulations from strangers, whereas before under the Securities Act, which generally requires registration if you want to go to the public, or raising money from private individuals under Regulation D, which are typically friends and family and people that you have a prior relationship with. And so what we have now is crowdfunding, which is taking place in a number of different areas. There are 4 types of crowdfunding at the moment. One is the donation type of crowdfunding, which has been around for years. People give it to the Red Cross. If you listen to National Public Radio, they come on twice a year and beg for money. Then you have the rewards type of crowdfunding, which you see in Kickstarter. The rewards-based crowdfunding has really kind of become legitimate now. It's now being featured in the Wall Street Journal, for example, and has gotten a lot of attention because a number of filmmakers and artists have gone out and raised incredible amounts of money, just essentially pre-selling their product. So, for example, singer Amanda Palmer, who happens to be have been in Southwest, has gone out and raised over $1 million to produce her next CD. Her husband, who I didn't realize until just recently, Neil Gaiman, who is an author, a sci-fi author, and a graphics novel author, has decided that since Amanda was able to do this, he's going to do it now with a film that he's going to start. Warner Brothers decided that, hey, this is a great idea because what we can do is we can get people to prepay for the DVD. And so Rob Thomas, who's the producer of a TV show called Veronica Mars, went out with some of his stars, Kristen Bell and a number of others, put up a very witty video, and they were able to raise over $5 million for their picture, which was essentially being produced by Warner Brothers. And so there was a little bit of subterfuge there, at least as far as the investing public was concerned. And essentially what this rewards-based crowdfunding is really just pre-selling a DVD or a CD or the product of what the artist is going to produce. And then there's equity crowdfunding, which is happening now to a certain extent under Regulation D. So you have some websites now up. One's called Circle.
And Jeff, tell us again what Reg D is.
I'm sorry. Regulation D is an exemption from the 33 Act, which permits private placements to accredited investors. Accredited investors are generally defined as people who have a net worth of $1 million or more, not including their homes, or income of $200,000 a year, or $300,000 a year per spouse. And so what this allows is people who are able to take the risk of such an investment, presumably because of their financial wherewithal, to invest in private transactions. And so some of these funding portals now, which are really a new thing on the internet, are starting to allow people under Regulation D who are accredited investors to get past the, what I guess the publishing world would call a paywall, but it's really just kind of a gateway. So once they determine that you are accredited, they will let you in to see the deals, and then you can invest from $100 to $1,000 to whatever you want to do.
So in a nutshell, traditional corporate finance is you're only allowed to access certain types of deals, which sometimes have stupendous returns, if you're an accredited investor, so that you've got worth a certain income level. Crowdfunding is trying to democratize that in the sense that you can have much less income, much less net worth, but you can only invest up to $2,000 a year under certain thresholds.
Right. So let me back you up just a second. So this Congress that we have right now hasn't been able to agree on very much of anything. But back in April of 2012, because of the way the economy was running and the fact that there was such a push for getting job legislation out in order to get people back to work, Congress passed by an overwhelming majority something called the Jobs Act of 2012. And as part of the Jobs Act, in Title III is the Crowdfund Act, which will now allow non-accredited investors, i.e. average investor, to come in and invest into these small, potentially highly lucrative businesses. Now, the Congress, the House has passed a very open bill which would allow anybody to come in. The Senate came back and put in some structural protections, one of which is what you mentioned, which is only to allow people to invest a certain amount of money so that their annual loss can't be more than, for example, the greater of $2,000 or 5% of your net income or your annual net worth. If you earn under $100,000, and if you earn more than $100,000, that goes up to 10% of your annual income or net worth, up to a maximum of $100,000. So even if you happen to invest in a company that does fried rabbit restaurants and it craters in a year, the most that you've lost is that initial investment. Now, the structural protections in the Act, and this gets into the reason why it hasn't gone into effect. The Jobs Act hasn't gone into effect because the SEC needs to promulgate regulations before this crowdfunding act can become effective. And not only does the SEC have to promulgate regulations, but the SEC is requiring that FINRA, which is the old NASD, which regulates broker-dealers, also has to promulgate regulations. Because not only do broker-dealers get to become portals on the internet for these types of acts, but they're also allowing kind of a hybrid broker-dealer to come in and create these websites such as Kickstarter and Indiegogo that will promote these portals on the internet. The funding portals are a creation and an invention of the Jobs Act, and they are going to be not broker-dealers, they will be essentially broker-dealer-like, and that they will be regulated as highly as current broker-dealers.
Jeff, let's do this. Let's assume that Cleverbridge is a startup. It's not a wildly successful international multi-trillion-dollar company. All right? Oliver's the founder of Cleverbridge. He wants to crowdfund it. Aaron, John, and Nate want to invest in Cleverbridge. Can you outline for us the players in this area, issuer, the portal that you started to do, and also issuer and portal investments?
Right. Well, one of the interesting things about the Jobs Act is it's created a lot of jobs. And the jobs that it's created are these positions which are ancillary to this new industry. And so one of the requirements of the Title III is that, for example, the funding portals are going to have to do some due diligence on the offering that Cleverbridge is going to make.
So crowdfunding is only permitted through portals. It's created by the Crowdfund Act.
Portals or broker-dealers.
Okay. Portals, broker-dealers, one player, second issuer, third investor. What's the relationship of the three?
Okay, so what will happen is that the issuer will go to the portal. They will provide them with their business plan and disclosure materials. The portal will put that information up on the internet. And then the investors will come in and take a look at the deal, determine whether or not they want to invest. They will fill out forms which are all electronic, read the disclosure. The act requires that there be educational materials, and there will also be a quiz to make sure that the investors understand what the risks are with respect to the business and the risk of illiquidity, because the securities that they're going to be buying will not be tradable for years. So, which is different than current. And so, what will happen is that the issuer will file a document through the funding portal with the SEC. 21 days have to pass before the first sale can be made. Okay. The money will come in, it will be held in escrow by an independent escrow agent, because the portals are not allowed to handle either the money or the securities. Once the deal closes, assuming that the target amount is hit before the deadline, then the deal will close, the money will go to Cleverbridge, and Cleverbridge will issue through the escrow agent the securities to the investor.
Are there any questions at this point about crowdfunding?
How's the price set? Sorry, I missed that one. How's the price of the security set?
The question is, how is the price set? The statute says that the price is set by the issuer, but the valuation has to be disclosed on the internet, and people can agree or disagree with the valuation of the company. No third-party valuation is required. And I think that the funding portals would probably shy away from getting involved in any part of the valuation. So if you're an investor and you believe that the valuation is too high, then you shouldn't invest. Part of the environment now that is starting up is that there are now what are called crowdfunding capital advisors who are looking at, starting to look at deals that are being done and telling people whether or not, the valuations are close. And I think that industry is going to get larger as this becomes more important.
In the waning 2 minutes of this session, are there any other questions before I move one there? Jeff, I guess final question would be, what kind of companies do you think will have these new capital markets?
I think that there will be a lot of startups, but I think too that there are a lot of companies around the country that are small businesses that have been blocked out of getting bank loans because of the tightening of the credit market. And so perhaps your local body shop who needs $1 million line of credit may go out and crowdfund for a debt security for $1 million, and then have terms which will be above market, more than what you would get, say, at your local bank, but less than they would get from Wells Fargo. And I think that would work for them as well. And so I think we're going to see a large differentiated class of people who are going to come in and use this facility.
We started 3 minutes late, we're ending 1 minute late, so we've caught up. Thank you for joining us.